You know, the 2008 financial crisis, it wasn't like a hurricane or an earthquake. It wasn't some random act of nature that nobody could have seen coming. Nope. This was a story. It had a beginning, a middle, and a catastrophic end. It's a story all about choices that people made and warnings they ignored. And believe me, understanding that story is the only way we can even hope to avoid repeating it. So let's start where all good investigations do, at the scene of the crash.
To really get what happened, first you have to survey the damage. And this wasn't just numbers on a balance sheet. The real collateral damage, well, it was measured in shattered lives and broken communities all across the country.
Take a look at this number, 26 million. That is the staggering number of Americans who were either out of a job, couldn't find full-time work, or had just given up looking altogether. The hopes of an entire generation just dimmed in an instant.
Then there's this one. $11 trillion. That's how much household wealth, we're talking retirement accounts, college funds, life savings, just vanished. Poof, gone.
And for 4 million families, the damage was brutally immediate. They lost their homes to foreclosure, and millions more were right on the brink. The American dream for so many became an absolute nightmare.
So when you look at that level of devastation, it's easy to think it was just inevitable, right? A perfect storm nobody could predict. But here's the thing. The official investigation uncovered something that changes the entire story, a central mystery.
The official government report put it as bluntly as you possibly can. They said, and I'm quoting here, the financial crisis was avoidable. It was the result of human action and inaction. This wasn't some random accident. It was a series of choices, a series of failures, a big miss. In that, right there, that leads us to the single most important question in this whole mess. If this catastrophe could have been stopped, then how on earth did it happen? And who was at the wheel?
All right, to find the answer, you got to follow the money. We need to trace this financial virus that started quietly in American neighborhoods and ended up infecting the entire global economy. It's called the mortgage securitization pipeline.
The whole system was built on a really simple but totally fatal idea. Pass the buck. Nobody had any skin in the game. It worked like this. First, lenders hand out incredibly risky mortgages to just about anyone. Second, Wall Street banks buy them up and bundle thousands of them together. Third, the so-called referees, the credit rating agencies, stamp these toxic packages with a shiny AAA rating, calling them ultra-safe. And finally, these financial time bombs get sold to pension funds and investors all over the globe.
So what turned this risky system into a full-blown doomsday machine? One word: leverage. We are talking about massive, mind-boggling amounts of debt. The entire financial system was basically running on borrowed money, making bigger and bigger bets every single day.
To give you an idea of just how insane this was, the Commission came up with this incredible analogy. Imagine you have a small business, right? You've got 50 grand in the bank. Now imagine borrowing $1.6 million against that and having to pay back almost $300,000 of it every single night. It's a recipe for instant collapse if one little thing goes wrong.
Which, of course, brings up the obvious question, where were the watchdogs? I mean, we have regulators whose entire job is to stop this kind of thing from happening. So why didn't they?
The sentries were not at their posts. That's how the report put it. See, for decades, the big idea in Washington was that markets police themselves, that the big banks would never be so reckless as to destroy themselves. And that belief, that faith in deregulation, it led them to strip away critical safeguards, leaving the whole system wide open.
And look, it wasn't because they didn't have the power. They had the authority to stop the flood of toxic mortgages, but they chose not to. They could have forced banks to keep more cash on hand as a safety cushion, but no political will. They could have shut down these risky practices, but instead they kept giving these firms a safe and sound rating, sometimes just days before they completely imploded.
So why the lack of political will? Well, maybe this has something to do with it. Between 1999 and 2008, the financial industry spent $2.7 billion on lobbying. That's billion with a B. They were paying to weaken the rules, and, well, they got what they paid for.
So, okay, the regulators failed. But what about the companies themselves, the CEOs, the boards of directors? Surely they knew the kind of insane risks they were taking, right? The Commission used the story of Icarus to describe the culture on Wall Street. You know, the guy who flew too close to the sun. They were so driven by short-term profits and gigantic bonuses that they just kept taking bigger and bigger risks with absolutely no fear of the consequences.
And the report is just filled with these jaw-dropping examples of recklessness. You had AIG, this massive insurance company, whose top managers had no idea they were on the hook for $79 billion in bad mortgage bets. You had Fannie Mae, which dove deeper into the risky stuff right as the market was peaking, all to chase bigger bonuses. And get this, the leaders at Merrill Lynch were literally surprised to find out they were sitting on a $55 billion time bomb. Too big to fail had somehow become too big to even manage.
So you've got a pipeline of toxic loans, supercharged with debt, regulators asleep at the wheel, and executives flying straight into the sun. When you put all that evidence together, you get a final verdict, and it's one that completely debunks some of the most common myths about what caused this mess.
So what about the idea that government policies forced banks to make bad loans? The commission found that that was not a significant factor. Well, was it all Fannie Mae and Freddie Mac's fault? Nope. They concluded that while they definitely contributed, they were not a primary cause. They were following Wall Street's lead, not the other way around. The final verdict comes right back to where we started. The principal clause was human action and inaction, real choices made by real people.
And that brings us to the report's final and frankly chilling warning. Believing that nobody could have seen this coming isn't just wrong, it's dangerous. Because if we tell ourselves it was just an act of God, that no one was to blame, well, then we are guaranteeing that it will happen again.
This crisis was the result of a chain of choices. The choice to deregulate, the choice to ignore warnings, the choice to chase short-term profits no matter the cost. Which leaves us today with one final, very unsettling question. Have we actually made different choices, or are we just waiting for history to repeat itself?